Welcome back. In the previous session, we have done up to retained earning estimation. So, retained earning comes after payment of dividend. The net profit belongs to the owner, as I said. Then you pay dividend out of the retained earning, and then whatever remains is out of net profit, whatever remains is the retained earning. This retained earning of the current year is added to the reserves and surplus of previous year to get this year's reserves and surplus. So, that is why we won't be able to prepare the balance sheet unless you prepare the profit loss account. Similarly, we won't be able to prepare the balance sheet unless we have the data on the cash that remains at the end of the business. So, we have to really prepare the cash flow statement first before we can go to prepare balance sheet. As I said at the beginning, maybe previous session, that there are means all the cash flows are thought to come out of three different activities, or all the activities are classified into three. One is cash flow from operating activities, cash flow from financing investment activities, and then cash flow from financing activities. So, operating activities are from the operation, we will discuss that. Investment activities are primarily wherever you invest money to create long term asset, or maybe you make some investment for long term purposes. So, all long term asset creation leads to use of some money, some cash, and that cash flow is termed as cash flow from investment activity. Cash flow from financing activities are mostly from whatever money you try to bring or you pay for previous borrowing or something. So, it is mostly borrowing, and the second it is your new equity capital that founders may bring. If you pay some dividend to them, that also comes under financing activities. So, anything that in the form of money that you either raise or you pay or it comes are all under financing activities. So, first off, let us talk about operating activities. The first item in the and know that this is indirect method. We will not discuss about direct method, that is a slightly lengthy method, but it makes the same thing. There is no difference. If you understand this, you will understand that as well without any difficulty. So, cash flow from operating activities, first part is net profit. So, when you prepared the profit loss account here, you estimated the net profit here. Remember, this is before payment of dividend and after payment of income tax. You have paid the tax, and this is the money that belongs to the founders, but you have yet to pay the dividend. Why so? Because you want to show the dividend separately in the cash flow statements. So, that is why you want to keep that separately. So, first item is net profit that comes from there, as I said. Second is you make normally if you refer to any book or any online material, they will say adjustment for depreciation. Understand this very clearly. Depreciation and amortization arise out of some expense or expenses that you incurred some time back and you have capitalized them, and every year you are charging your profit loss account a portion of these expenses. So, depreciation is coming out of your long term asset, your cost of acquiring long term asset. Say you have procured that in 2015 or 16, or some you have procured this year also 17, 18. Irrespective of that, you are not charging your profit loss account with the entire cost of the asset that you have created, but you are charging only a small portion of that. When you have procured the asset, you have already charged your cash flow statement with that amount, exact amount, not depreciated amount, that we will see at this place, investment activity. You have purchased a truck and you have charged your cash flow statement with the entire amount, no relation with depreciation, but this will remain in your books of account, but periodically you want to charge a portion of that to the profit loss account and then recover the money. So, this year whatever depreciation you have allowed, you have not actually incurred any expenses. These expenses were incurred when you procured the asset, but every year you are charging your profit loss account, which means that your profit is reduced by this amount. Why you do that? First of all, you want to pay less tax, because any government will allow you to do this, because this is a real expense that you have already incurred, but you have not charged your profit loss account. Now, you are charging gradually in an installment. So, this is from accounting point of view, this is absolutely justifiable that every year you charge portion of your long term asset, cost of procuring long term asset in your profit loss account, but money is not going away from your company, your books of accounts. Money is with you. You are just showing an entry in your profit loss account. That means the money that you have shown in your profit loss account, as if the money has gone, which has not actually gone out. So, in effect, your, as I said, the money that belongs to the founders owes this amount, owes 504, that we have shown as if this money belongs to the founders. The reality is that other than this money, the depreciation and amortization also belong to the founder, because this money has not gone out. So, at this place, if you estimate another item called cash profit, this will mean whatever net profit you have made, which is 504, you add depreciation as well as amortization to this. We have deducted total depreciation of this. You also add amortization, which is which is a non-cash expense, meaning cash has not gone out. So, you actually made a cash profit of 788. This is a technical term. It is very extensively used. Net profit and cash profit. This is the total profit in the form of cash that you have made. You see any balance sheet in, say, Bombay Stock Exchange or National Stock Exchange, whatever balance sheets are submitted, you will find a net profit as well as a cash profit. So, this is the cash profit. So, to account for that, we are adding this to our cash flow from operating activities. So, you are making adjustment for depreciation, you are making adjustment for amortization. These are cash inflow, because cash is coming into the company. Net profit is coming into the company, depreciation is coming into the company. So, these are cash inflows. Now, one thing is to be understood, that there are cash equivalents. Some cash is coming to the company and going away. This will be available only when you prepare a portion of the balance sheet. So, before estimating the cash flow statement, you have to really do part of the balance sheet. So, I will show you again, or maybe we take a detour and then come back to the preparation of balance sheet, and then we will go back again. So, suppose we are preparing the balance sheet. After preparing profit loss account, we prepare the balance sheet. Let us see how we can do that. So, forget about the cash for the time being. We will prepare that later, whenever, say, we delete this data 348. We delete this data, just we will write it here so that we remember. 348 is the cash. So, say closing stock of inventory, this is the balance sheet format that is already there. Now, we prepare asset first, then we prepare the current asset first. Whatever asset is most liquid, that comes first, whatever is less liquid goes downward. So, first thing is cash. We cannot prepare, we cannot have data on cash unless we prepare cash flow statement. So, we have deleted that. Now, closing stock of inventory is this is the as per last account, but for this account you have to take data from your ledger. So, this is already given here at the first column. this is given here somewhere, the closing stock has to be given, meaning that you already have access to the ledgers. So, closing stock somewhere it will be mentioned. So, here it is 150. Likewise, there are some balance sheet data which will be available directly from ledger. This data has to be just captured from here itself and then replace it there. Incidentally, major items in the balance sheet are available in the ledger. So, preparing the balance sheet should be a cakewalk, because majority of the data are already given, like trade receivable is given in the first column. So, if you have the cash data, this part is done. Land, so you have 300 rupees worth of land, then you go back and see that you have procured 500 rupees worth of land. So, add that 500 with 300, you get 800. Now, building this is important to show. So, I will go back, wasting some time. See, when you estimated depreciation, here is the estimation of depreciation. You had the last year account, then you add purchase, then you have total depreciable value, then you depreciated, then this is the book value. These goes to the balance sheet as the current year's value. Similarly, machinery, it is the last balance sheet data, then you have procured or purchased during the year, this becomes subtotal, you have sold some. So, this became total depreciable asset, then you have depreciated at the rate of 10%, this becomes the net value after depreciation, which goes to the balance sheet. So, you have this data already prepared. So, you do not have to do anything for the time being. So, plant and machinery, this is the previous data, and you have already estimated that after depreciation you have this data, here plant and machinery 1341. Now, coming to preliminary pre-operative expenses, this was 1000. During the year you have already amortized, meaning almost like depreciated this value by 100. So, whatever is left is 900. 900 is to be amortized over a period next 9 years. So, every year you amortize something, your capitalized part is reduced by that amount. See the narration, preliminary pre-operative expenses to the extent not amortized, meaning this is the previous year it was 1000, but you have already amortized 100. So, whatever is left is 900, this is to be amortized. So, this is the total asset. Then liabilities. So, owner's equity, you see earlier year it was 1000, but if you see the first column you will see that owners brought in another 500. So, you have to add that with the previous account to get this year's data, that is 2018. Similarly, reserves and surplus, earlier year it was 530, then you add the next current year's retained earning or retained profit to get reserves and surplus this year, that becomes the total owner's equity. Now, trade payable data is already given there in the column, because this is a balance sheet item, you cannot get it through any calculation. Short term bank loan outstanding balance is already given. So, remember short term bank loan, there is no subtraction addition, whatever is the balance that bank will tell you, you have to put that data, substitute it here. Now, long term bank loan is slightly critical, not very critical. So, earlier year you had a balance of 1000. Now, you have to see whether you have repaid any amount. So, this year actually you have repaid 50, that is given somewhere in the first column. So, first column you will see repayment of bank loan somewhere here. So, 50 worth of bank loan was repaid. At the same time you have raised fresh loan of another 100 or so. Raise fresh loan, somewhere it will be mentioned. So, that 100 is to be added again, because fresh long term loan raise 100. So, earlier year the balance was 1000, long term loan was 1000, you have repaid 50, it became 950, then you have added new 100, it becomes 1050 subtotal. Then that makes your total long term liabilities, and you are done. Now, if you have the data on cash, your balance sheet is done. So, let us see. Now, to understand cash flow from operating activity, we are back to cash flow from operating activity. First item is net profit, that comes from your profit loss account, then depreciation, amortization are already estimated. Now, inventory, this is actually adjustment of inventory or increase decrease in inventory, it is not really total inventory. So, it will be proper to write addition and subtraction, or maybe some people would write it like adjustment of inventory, some people would write increase decrease in inventory. So, whatever you prefer you can write, but understanding is more important than writing. See, if you are here in this case, this is the difference. Your inventory now is 150, previous year it was 120. Inventory means a stock, closing stock. In manufacturing setup, it will be inventory of raw material, goods in process and finished goods. That is why we are not taking it up. For trading account, it is just the stock, because there is nothing called in process goods or in process or finished or anything. So, at the end of current year, as on 31st March 2018, your total stock is 150, whereas in the previous year 31st March balance was 120. There is an increase in the inventory. Now, look at it this way, inventory requires money. If you want to increase your inventory from 150 to 200, you need another 50 rupees from somewhere from your cash to purchase this stock. Do not go into whether you are purchasing on credit or cash or anything, just look at the inventory per se. If inventory goes up, meaning some money is utilized, meaning that some money is going out of your cash box, something like that. So, inventory going up is cash negative. Similarly, trade receivable also is you are suppose manufacturing or you have sold some goods, that goods requires money, you are yet to receive the payment. That means, from cash box some money has gone out. So, receivable going up is, if it increases, meaning some money has gone out. Now, when you look at trade payable, see here also something has gone up. It was 90, but it has gone up to 150. So, increased by 50. Understand this very clearly. Trade payable means what? Meaning you have procured raw material from somebody, you are yet to make the payment, meaning that somebody has given you material that he bought with money. So, it is in a sense you are getting some money from somebody to do business, run business. It is called cash equivalent, meaning it is not real cash, but cash equivalent, meaning that you have received some cash from somebody. So, 60 rupees worth of cash has come in. So, payable going up means cash positive, meaning cash flow cash inflow. So, let us consolidate this now. So, net profit is cash inflow, because net profit cash is coming in, depreciation is coming in, amortization also is coming in. Now, increase in inventory, meaning that inventory is going up, so it is cash negative, that is why it is minus. Increasing receivable also is cash negative, because money has been utilized to increase receivables, so it is going up. Whereas payable has increased. So, you can very well write here increase in payable, you can write anything, that is up to you, there is no hard and fast thing. So, payable has gone up. So, this is cash positive, because somebody has given us cash equivalent in the form. So, total is all the positive that you sum total minus the negative, you get 788, that is your total cash flow, meaning cash inflow, because it is positive. Cash flow from investment activities, see you bought some land, that is 500 rupees. So, you have paid money to somebody, whether you pay or you delay the payment or anything, it is cash equivalent. So, negative cash flow is happening. You have to look at it in isolation, not really in holistic. You have constructed a factory shed, cash has gone out. So, this is cash negative. You have bought equipment worth of 200, you have bought truck worth of 300, you have bought telephone worth of 20. So, you have bought computer out of worth of 20. So, all these are cash outflow, cash has gone in, whereas you have sold some machine for 50. So, cash has come in, machine has gone out, but cash has come in. So, the net amount, sum total of them minus the telephone is minus 1190, which means 1190 worth of cash has gone out. So, from operating activity cash has come in, from investment activity cash has gone out. Now, let us see financing activity, what all we have done. We have the founders brought in new equity. If you want to see them here, you see this column, you will find that founders have brought in 500 like this, founders contribution to new equity, meaning 500 worth of equity has come in. So, that is why this cash flow from financing activity equity has come in. Now, long term loan, as we have discussed, but this is not the total loan, how much is the net amount. So, we have raised 100 amount worth of long term loan, 100 rupees worth of, but we have repaid 50. So, 100 minus 50, which means we have raised loan, meaning cash flow positive cash flow, or is there something, let me see what is the formula that I have used. This is B minus, meaning that just you pick up this data from here, long term loan. Earlier year it was 1000, this year it is 1050. So, the difference is 50, and if the long term loan has gone up, which is a positive cash flow, that means this should not be negative, this should be positive. Long term loan is positive cash flow. So, this should not be negative, this should be positive. I am sorry, it is going haywire. This should be is equal to long term loan. This is a cash positive, cash coming in. Similarly, fresh, oh I see, I am sorry, this is actually long term loan repayment. So, this is negative, this is perfectly okay, this is negative, long term loan that you have repaid. So, there should be a negative sign here, repaid, that is right. Fresh long term loan raised is 100. So, this has come in. So, this is positive. Short term loan, you have to see whether the balance has gone up. Short term loan balance has gone up by 200, which means 200 rupees worth of new money has come in. So, this is cash inflow, that is why it is positive. Dividend has gone out. So, dividend is negative. So, this is the total. So, total cash flow, this means cash flow from financing activity plus cash flow from investment activity plus cash flow from operating activity. All these three together make a positive cash flow of 650. Just add them up, you will find 650. So, no sorry, 650 is this is from investment financing activity, this is from investment activity, this is from operating activity. So, 788 plus minus 1190 plus 650 makes 248. So, this is the cash flow from this year's activity. Now, you started the business with some cash that is there in your previous year's balance sheet, which is nothing but cash in hand and bank, which is 100. So, this 100 is to be added to the cash that you have made, surplus cash. So, new cash is this plus 100, which becomes 348, and this 348 is the cash balance in today as of 31st March 2018. So, you just make is equal to, you pick up this data from there, which is this, and say equal to, enter. So, you have the cash position here. Now, you see the total, because everything is in formula. So, total of this year has become 4334, and see what is here, liability also is 4334, meaning 4334. If you do everything correctly, then there is no reason why liability and asset will not become equal. So, you have asset is equal to liability. So, a cash flow statement is very critical even before preparing your balance sheet. Of course, partially you have to do to understand what is the difference between this, otherwise you have to really pick up data from your ledgers. So, just to avoid that, you prepare the partial balance sheet without cash position, and then you populate the cash position after preparing the cash flow statement. So, cash flow has 3 items. One is from operating activities, another is from investment activities, another is from financing activities. Everything together, you have the balance cash flow at the end of the year. This pertains to the current year, and then you have to add the previous year's cash balance to get the cash balance as on 31st March 2018, and that goes to the balance sheet. I will end it here. It has been a long exercise. So, thank you. We will meet you again moving forward.